Our top line forecast for electric vehicles is that sales will increase roughly eightfold from 4.8 million units in 2021 to 40 million units in 2026, roughly 53% compound annual growth rate each year. And what's really driving this is battery cost declines. We think that by 2023, a electric vehicle is going to reach sticker price parity with a like-for-like gas-powered car. And at that point, it should really be a no-brainer.
Could be worth about $25 trillion in terms of enterprise value by 2030.
On a revenue basis, the total addressable market is about $11 trillion. Our expected value for Tesla stock price in 2026 is $4,600 per share. Our bull price per share is $5,800 by 2026.
In this video, Ark Invest's team of analysts share their thoughts around Tesla, Tesla stock, autonomy, the opportunity for AI, and plenty more. So let's get into it. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks. Check out the links in the pinned comment below. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. So check out the links in the pinned comment below, and thanks for your support.
So we're so excited that we just published our latest Tesla valuation model for our 2026 price target. I have here with me, I'm Tasha Keeney. I'm here with Sam Corris and Will Summerlin. We're all ARK analysts. Tesla is a great example of how our research converges at ARK. So Will is our AI specialist. Of course, you know Sam, an expert on electric vehicles and their batteries. And I cover autonomous technology and autonomous driving. So first, we'll kick it off by explaining some of the background of our top-down research and how it applies here. And then we'll get into the model itself.
You know, just tying into ARK's research ecosystem here in the convergence, right? We have top-down models for electric vehicles. We've got Will, who's talking about AI and foundation models and training there, and then Tasha from autonomous. So we all get together and brainstorm, and that's how we make the Tesla model.
Oh, so that explains why Ark Invest have absolutely no idea about anything. Rather than assigning a single analyst to a particular company to understand their stock, instead these crazy morons, for some strange reason, have multiple analysts covering the same stock, discussing and collaborating. I mean, why on earth would you possibly want an electric vehicle and battery specialist also involved when you've already got an autonomous specialist and an AI specialist? I mean, surely one of them would be sufficient to completely understand Tesla, the company, and the opportunity in the stock, right? I don't know what they're doing. Ark are insane. Why aren't they copying the typical Wall Street model? where an automotive analyst is covering Tesla stock and has been wrong for the last 10 years running. I don't know. I mean, can somebody please send a note to Ark Invest, you know, since they're really open and like feedback? I mean, you guys are just so dumb. Like, the less analysts, the better. The less collaboration, the better. The less competent you are, the less capable you are of actually understanding each separate element of Tesla's business, the more accurate your price predictions will be, right? Right?
I guess to kick things off, we'll start on the electric vehicle side of things. And our top line forecast for electric vehicles is that sales will increase roughly eightfold from 4.8 million units in 2021 to 40 million units in 2026. And that's a global number.
Now, I don't know for sure, but my best guess is that approximately 0 out of every single Wall Street stock analyst covering Tesla stock actually believes that even close to 40 million electric vehicles could be sold in a single year by mid-decade or so. Beyond the likes of Rethink X, Tony Sieber and co., some of the crazy, deluded people at Ark Invest, I think it'll be hard-pressed to find anyone, except maybe a few people that have really done a lot of digging, who'd think even close to this number. At best, maybe 10 million electric vehicles, 15 if you're lucky, in the most bullish scenarios. If memory serves, and honestly I might not remember correctly because if my brain hears garbage it tends not to necessarily remember it, I think Moron Stanley were expecting that around 30% of new vehicles sold in the United States in 2030 will be electric, and globally less than 50% in 2030. I know to most people watching these kind of estimates sound absolutely insane, but there's good reason to believe this will come to pass. Let's hear Ark Invest explain exactly why. And just before they do, remember, if there's ever a major disconnect between consensus opinion and what's likely to take place, that gap is called opportunity, at least when it comes to the stock market. If you can't read between the lines, Too bad.
And that'd be a roughly 53% compound annual growth rate each year. And what's really driving this is battery cost declines. And so we use Wright's law, and this is across many different themes and technologies. But for batteries, it's so important because the battery is the single largest cost component of the vehicle. And so Wright's law states that for every cumulative doubling of production, you get a fixed percent cost decline. And for lithium ion batteries, that's roughly 28%. And so we think that by 2023, a electric vehicle is going to reach sticker price parity. So that's the upfront cost the consumer sees with a like-for-like gas-powered car. And at that point, it should really be a no-brainer. And we think that we're going to see a huge shift in demand towards electric vehicles.
I almost get the feeling that Ark Invest have been watching Solving the Money Problem. I'm just kidding. But clearly we think quite similarly. Now, there's absolutely no question. One, the battery is the single most expensive item in an electric vehicle by miles. I get it, miles, that's bad. The point is, battery can cost close to $10,000 US. If you're selling a vehicle for $40,000, $50,000, the battery could be a quarter of the entire price, based on Wright's law. For every cumulative doubling of production, remember today EV production making up just a few percent of global vehicle production. Every time this doubles, Ark Invest expecting about a 28% decline in the cost of the battery. This could be more than $1,000 for every cumulative doubling. And as Ark point out, they believe in just a couple of years, at most, average electric vehicle reaches sticker price parity with an internal combustion engine vehicle. And here's the kicker. As Ark Invest said in slightly more politically correct terms, at that point, buying an EV becomes a no-brainer. As I've said on this channel repeatedly, at this point, you literally need to be a fucking moron not to buy an EV. Different words, same message. People don't seem to get this, especially not legacy automotive manufacturers who for some strange reason still believe today, at least based on their publicly stated goals and ambitions, that there'll be enough consumers without brains that they'll still be willing to pay more money for an inferior, less safe, higher cost of maintenance vehicle that, oh, by the way, also pollutes and is increasingly more expensive than a comparable electric vehicle. This is the crux of the entire argument. Within just a couple of years, consumers will literally need to be stupid to continue purchasing ICE vehicles. Now, yes, there's plenty of stupid people on the planet, but is there really enough to continue buying 40, 50, 60, 70 plus million internal combustion engine vehicles every year? I don't think so. And how does this play out for legacy automotive manufacturers who think consumers are still going to be buying ICE vehicles in 2030 and beyond? Bankruptcy, okay? They go bankrupt. Of course, you might think, Stephen, well, what if they change their mind? What if they figure it out? Well, guess what? It's way too fucking late. We're watching a slow motion train wreck unfold here. It's like trying to turn a gigantic ship on the ocean on a dime. It's not going to happen. They may realize, oh, we're headed directly for an iceberg, but it's already too late. Turning a giant ship around, slow and brutally painful process. There's not enough time to turn the ship. They will be sitting at the bottom of the Atlantic Ocean in just a matter of years. Watch.
With that, I'll pass it to Will to talk about AI.
So one of the opportunities we're really excited about within AI is the opportunity for foundation models. And to dig into this a little bit, one of the things that we've seen historically is that the larger models are, AI models, the better they perform. And this is a trend we think will continue. We've seen this with models like GPT-3, which is trained on most of the text from the internet. And we've seen this across DALL-E and BART and a number of other large language models. We think that the same principle will apply within the other application of AI, which is helping robots move through the physical world. And Tesla has really unique data assets in that they've seen billions of miles across their fleet and use that to train their own models for full self-driving and autonomy. We think there's actually an opportunity for Tesla to make those models openly available so that other developers, other companies can actually build applications and products on top of Tesla's models.
This is definitely a strong possibility. Remember, Tesla has a huge lead. They've already built most of the foundational block that is required for intelligent real-world AI, meaning AI that can be deployed in some form, whether it's humanoid or otherwise, and move throughout the real world. This is very different from an AI that's great at selecting search results or recommending you other products to buy on Amazon. Tesla's lead here is so ridiculous that at some point in the future, it's very likely, in fact, it's inevitable that people are going to want to be able to access this data, the foundational building block. Whether or not Tesla is open to monetizing that data and allowing, different story. Should Tesla do this? Potential revenue here is absolutely staggering.
This is what we call a foundation model. So based on our research and big ideas, we think the opportunity for foundation models could be worth about $25 trillion in terms of enterprise value by 2030.
Don't worry, folks, nothing to see here. It's not like that was a $25 trillion opportunity by 2030, an opportunity in which Tesla already has a gigantic lead and surely is likely to gain a large portion of that huge enterprise value. Of course, things may not play out this way, but if what I'm suggesting is accurate, Tesla does have a lead here and no one else is even close, and these models will in fact have that type of value in the future, seems like Tesla has developed yet another gigantic future money printer.
And we think the market will bifurcate. There will be models that are used to solve problems in sort of digital native context. And so these are models like GPT-3 and DALL-E that can help edit text or manipulate images or generate stories. And then we think there'll be a different use case, which is helping robots move through the physical world. And we think that'll be a different set of foundation models. So while Tesla hasn't actually openly discussed this strategy, we do think it's a possibility, especially given Elon's excitement around AI and given their unique data assets, especially given their investments in compute. And so we're very excited to see how that opportunity could manifest.
I don't know what these idiots are talking about, honestly. I mean, it's not like Elon Musk just tweeted today, Tesla AI Day #2 on August 19th. So many cool updates. And then it's not like he followed up to that particular tweet saying, yes, the purpose of AI Day is to convince great AI, software and chip talent to join Tesla. So nothing to see here. It's not like Tesla has anything to do with AI. They're not heavily recruiting for AI. They're not one of the world's leading AI companies. Everything Ark Invest said about Tesla and their AI opportunities, clearly wrong. Because after all, remember, Tesla's just a car company.
One of the biggest potential markets that we see in AI is autonomous driving. And we think that all vehicles in the future, all passenger cars will be electric. So when we talk about autonomous cars, they're electric autonomous cars. Ultimately, why we're so interested in autonomous driving is because we think that it could dramatically lower the cost to get around. So an autonomous taxi could price as low as 25 cents per mile. That's less than half of the cost of driving a personal car in the US, a new personal car. That's really dramatic. It's going to bring a bunch of people into the ride-hail market that are not customers today because of that extremely low cost point. Of course, cars will be a lot safer too, but ultimately we think cost is going to drive demand. And we think that this is such a large opportunity. On a revenue basis, the total addressable market is about $11 trillion.
$11 trillion, is that all? I mean, yeah, nothing to see here. I definitely wouldn't be trying to find any companies that appear to have unassailable leads in terms of developing safe autonomous vehicles because, more than $10 trillion of opportunities, it's not even worth, who cares? That's nothing, right? It's not like the world's biggest companies today aren't even a third of that in terms of value. Oh, wait.
And that's really our updated work on autonomy. So it could be as cheap as 25 cents per mile for a ride, but we also see a lot of demand at the 50 cents to $1 range for existing customers today that are either traveling around for their own personal needs or for work-related travel. We've done some analysis on how customers value their time to dimension those price points. Ultimately, we think that the platform providers or the companies that own the technology stack that allow cars to be autonomous could enjoy an enterprise value of $11 to $12 trillion by 2026. So this is really a massive opportunity and one that Tesla is uniquely well set up to participate in, as it's both a vehicle manufacturer and potentially an autonomous platform provider. And with that, let's get into the model.
Yeah, Tasha, let's just get to the meat of it right off the bat. What is Ark's 2026 price target for Tesla? And then we'll go into the methodology.
Right. So our expected value for Tesla stock price in 2026 is $4,600 per share.
Just for the record, my own Tesla stock price target for 2026, the bear case is just a little bit under where Ark are in their expected case. Obviously, my base case, bull case, and hyper bull case are significantly above this figure. If you want access to my price targets, check the card in the corner or the link in the pinned comment to join Patreon. You'll also gain access to well over 100 videos and loads of other perks.
We got there by, we have a Monte Carlo simulation that we've run 1 million times, and the expected value is the average of all of those simulations.
Just want to share a few thoughts on Ark Invest Monte Carlo simulation, and that's how they arrive at their Tesla stock price targets. I've seen a lot of criticism about using a Monte Carlo simulation. For those of you who don't know, without getting too nerdy here, basically a Monte Carlo simulation has a ton of different inputs reports, different scenarios, each with their own probabilities. In other words, this scenario we see is extremely improbable, so let's weight it accordingly, but include it in the simulation. This scenario we see is quite probable, we'll use this with a high probability, and so on. The end result, after basically averaging all these different probabilities, get a distribution of outcomes. And Ark Invest picked the 25th percentile, 75th percentile, and that's how they come up with their targets. Now, a lot of people criticize this. What are you talking about? This is crazy shit. And I totally understand the argument, except I actually believe that this is a very valid method. Now, you might say, well, how does that make sense? Wouldn't it just be better to just come up with one scenario you think is going to take place and then make all your predictions based on that exact scenario? And I would say, no, that's completely fucking moronic. Unless, of course, you have enough hubris to believe that you actually know exactly how things will play out to the T, in which case, sure, your one true scenario, just this is exactly what will happen. There's no possibility that anything else will happen. No chance anything goes worse. No chance that anything goes better. Why should I take the time to think through what are the absolute extremes? What's the possible range of margins we could have on automotive? What's the possible range of vehicles produced per year we could have in any given year? No, that. Why would we even think about that? Only one scenario can possibly take place. Let's just go with that one and everything will be based on that. Now, some people fail to understand and recognize that valuing a company, price targets, valuation model, it's more art than science. If it wasn't, you'd think that price targets would be a little bit more accurate. Now, if anyone has a better way of valuing a company than using a number of different scenarios and weighting them by probability and trying to figure out somewhere in there, okay, where do these kind of point to? I'd love to know, and I really would. Please let me know in the comments below. What is a better approach than that? In my own Tesla valuation model, I have 4 scenarios. I have a bear case, 5% probability. I have a base case with about a 60% probability, bull case with a 33% probability, and a hyperbull case with a 2% probability. Why? My bear case is my best guess. Again, this is more art than science. My best guess of a 1 in 20 worst case downside scenario. Almost everything that can go wrong does go wrong. Where do we end up? My base case, which almost has a 2/3 probability based on, again, my own assumptions, is what I think is the most realistic scenario if things go relatively well, but there's a few bumps along the way. My bull case, with just a 33% probability, 1 in 3 chance, is thinking, okay, what if a few extra things go well? Where do we end up then? And of course, my hyperbull case, 2% probability, is simply to test the absolute extremes. What's the 1 in 50 scenario? If almost everything goes right, where do we end up? This isn't a prediction of this is where things are going to go because I don't think it's likely. That's why it's a 2% probability. But to not factor in these range of probabilities, these range of outcomes, to weight them on probability and go from there, to me, seems really dumb. Again, I'm open to ideas. What is a better way of valuing a company than probabilistically weighting scenarios and going from there? I have a pretty strong feeling that every single person that strongly objects to the idea of a Monte Carlo simulation, multiple different outcomes weighted by probability, doesn't know the first fucking thing, and I want to be clear, doesn't know the first fucking thing about what's popularly known as Feynman path integrals. Rather than me trying to explain and butcher this, let's head to a quick clip from YouTube, give you a little bit of a taste of what we're talking about here. If you can't figure out how this applies to Monte Carlo simulations, Tesla stock, I'm not going to help. If you're really curious, I'll put a link in the description of the full video. And if you're a science-ophobe, please don't let this put you off. We'll get back to Ark in just a moment, but it's extremely important to understand this. I can't think of a better way to value any company, especially not one with so much uncertainty. Please understand there is a lot of missing context in the following clip. If you really want to understand this, you need to go watch the original source video. I'm just trying to give people a little bit of a taste of where we're coming from here and what we're talking about and why this Monte Carlo simulation makes sense.
The idea is essentially this. To know the likelihood of a particle traveling between 2 points, A to B, we need to take into account all of the conceivable ways that could happen. The double-slit experiment is a special case where we only think about 2 possible paths. But when something travels through empty space, it's like it's traveling through infinitely packed barriers, each with infinite slits. There are infinite possible paths, and Feynman actually figured out a way to combine the infinite paths to give a very real, finite probability of a particle reaching its final destination. His trick was to slice the time taken for the journey into small intervals, and at each time step, allow the particle to take any conceivable straight-line step in space. That gives a set of paths from A to B, some of which look sensible, but most of which are ridiculous. For example, there are paths that loop in circles or take detours to the edge of the universe. There was absolutely no physics in this description so far, not even the limit of the speed of light. Then, using the miracle of calculus, he was able to add up the contributions from all of those infinite possible paths to find the probability of a particle making that simple journey from A to B. Feynman's paths don't each have some separate probability of occurring. Instead, each path contributes what we call a probability amplitude to the entire AB journey. And Feynman used this action quantity to figure out the probability amplitudes of his infinite paths. Something amazing happened. All of the really crazy paths cancelled each other out. Only the most sensible paths, those with the least action, added significantly to the probability. When I say there are lots of ways for a particle to travel from point A to B, I mean lots. It's not just that a particle can travel infinite physical paths, also infinite things can happen to the particle on the way, and you have to account for all of them. For example, a photon traveling between 2 points could spontaneously become a virtual electron-positron pair before they annihilate back into the original photon. And a traveling electron could emit and reabsorb a photon, which itself could make its own particle-antiparticle pair ad infinitum. Let's not even get started with the complexity of two or more particles interacting.
Now, I know most of you have already fallen asleep, but this really matters. The whole idea here of a particle traveling through space with infinite possible paths, this is the same exact method being used in the Monte Carlo simulations. But instead of the different paths a particle can take, you guess it, we're talking about the different scenarios for, in this case, Tesla. E.g., how many vehicles can they produce? Is it 20 million a year in 2030? Is it 18? Is it 75 million? Is it 12? Is it 1 car? If you combine all these different scenarios, you get a relatively reasonable estimate of where things are most likely, in probabilistic terms, because there's no certainty here, most likely to end up. This is why Ark Invest looks at 25th, 50th, and 75th percentile scenarios. Again, I know most of you are like, what even the is this guy talking about? If you really want to understand this, it's kind of important. And if you don't, just don't be one of those douchebags who says this Monte Carlo simulation is completely pointless, stupid, makes no sense, and I highly disagree with it unless you got a better method.
And then how does Ark get to its upside and downside cases?
Our bear case for Tesla is $2,900 per share in 2026, and that is the 25th percentile of that million simulation run of a Monte Carlo analysis. So in other words, we think that 25% of the time, Tesla could be worth $2,900 per share or less. And then our bull price per share is $5,800 by 2026.
Funnily enough, for the record, my base case for Tesla stock 2026 is almost identical to Ark's bull case for Tesla in 2026.
So that is the 75th percentile, or in other words, we think that there's a 25% probability that Tesla could be worth $5,800 per share or more by 2026. So ultimately, this is all, again, a result of the Monte Carlo analysis. And our Monte Carlo model is built up of 38 input variables, which we give a range of possibilities within the model. And ultimately, these are the factors that we think could have some impact on Tesla's 5-year price target.
38 inputs is a lot here. I think, when we built the model, we then, tested it and we found the key inputs. So what are those 5 key inputs that we think are really the main drivers of this model?
So our 5 key inputs are capital efficiency, how the maximum production increase that Tesla can get in any given year. So how much they're able to increase production year over year on a percentage basis. We also have an input for how many cars we think will be on the ride-hail network by 2026. This is the potential for Tesla to launch a human-driven ride-hail network by that point. And then we also have the estimated launch year for robotaxis. So for autonomous ride-hail, when do we think that launch could potentially happen? So while we do, those are our 5 key inputs out of the 38. And then, you'll notice as you play around with the model, which is open sourced and available on GitHub, that the ones that really affect it the most are our assumptions around capital efficiency and autonomy.
Great. So before we dive into autonomy, because that's really where the bulk of the value is coming from, maybe I'll just touch on capital efficiency and how we're looking at it and some context around that. And so originally when we were doing research on electric vehicles, we were saying, what is the capital efficiency, or how much money needs to be spent for an incremental unit of capacity to be built in the auto industry as it stands? And that number was $14,000. And so that's kind of what we had used and said, okay, this is the baseline if Tesla matches industry average. And so if you go and you look in the model and our blog, you can see that when Tesla first started ramping the Model 3, their capital efficiency was far, far worse. They were at roughly $84,000 per incremental unit of capacity. But they dramatically improved. And in 2021, they were down to $7,700 per incremental unit of capacity, which is pretty remarkable, right? Already half of what the industry average was.
All right, folks, move along. Nothing to see here. It's not like Tesla is twice as capital efficient already in terms of producing vehicles as the rest of the automotive industry. This is certainly not a relevant metric and should not be considered any further.
And so in the Monte Carlo, we say that in the downside case, they just marginally improve and stay at roughly $7,000 per unit, incremental unit of capacity. But in our upside case, we have that cost coming down to $2,000. And I think what's really interesting is if you play with the model, you can see that, this input itself is actually not as meaningful as it was in the past because Tesla is no longer capital constrained. And so what that means is that, their ability to scale production is not based on how much money they have in the bank account, how much money they can spend. It's really based on management bandwidth, whether or not there's supply constraints, which have been particularly relevant over the past year. And so that's where this other key input comes into play, which is the maximum annual production increase. And, this is probably one of the bigger drivers on the vehicle production side of it. But then, Tasha, I'll hand it to you to talk about autonomous because really the launch year and when adoption happens, I think is the single biggest driver for this model.
Thanks, Sam. Robotaxis do have, a very large impact on our valuation target. You'll notice that in the blog, we've broken out that they will contribute approximately 60% of the expected value in the model can be attributed to robotaxis. And we've changed a little bit the way that we've modeled this versus last year. So last year we had a single input, which was the probability of robotaxi launch within the 5-year window. But we changed that this year to have, we still have that probability input, but we also have the robotaxi launch year input. And effectively, this is just because I think this is a little bit closer to how people think of, whether or not Tesla will launch robotaxis. It's, okay, if it happens, which year will it happen, if at all? And so you'll notice that, in our downside case, we're assuming that Tesla launches in 2026. So that would be 4 years after Elon Musk has said that he expects to solve for full autonomy. And in the upside case, we're assuming a launch year of 2023. So again, that would be actually 1 year after what Elon has said could possibly happen.
And again, for context, I'm personally expecting the first robotaxi fair to take place somewhere on planet Earth, sometime, most likely late, in 2024.
At the midpoint of our assumptions, it's the 2024 year. So about 2 years later than expected by the company. And I also just want to point out that 9% of the time in the model, the launch year actually falls out of the window that we're forecasting out of that 5 years. So effectively in 9% of our simulations, we're including no revenue for autonomous taxis at all. Another thing that we updated that I alluded to earlier is how we think of the price points that we'll see in the autonomous ride-hail market. So, when we first did our analysis on autonomous taxis, we saw that they could be priced as low as 25 cents per mile. But ultimately, we think that, ride-hail has proven that there is demand around the $2 to $4 per mile price range that we see today. We think that because consumers in Western markets, our analysis shows that they value their time at roughly equivalent to average hourly wage for miles driven with the purpose of going to work. So for commuting miles at roughly equivalent to hourly wage. And then for non-commuting miles or driving that you're doing for your personal use, that's valued at roughly half of hourly wage. So that gives a lot of demand in Western markets at price points of about $1.10 to 60 cents. And then in lower income countries, we expect significant demand at the 50-cent mile mark. That's because if you look at how Didi is already pricing ride-hail options in places like China today, it's already pretty inexpensive at about 50 cents. So ultimately, the 25 cents per mile price point comes in, and we think that this will be the long tail of additional customers that will now be brought into the ride-hail market that were not there before. That's where we see a dramatic change in habits, and again, in additional people coming into the market for this extremely cheap service. So ultimately, all of those price points get factored into our model. We're assuming that once Tesla penetrates a certain segment of the market, if they keep on adding autonomous miles, they fall into the next price point segment, and that's ultimately how you can think of it factoring in. What's the end effect? Well, we think that there's more opportunity or more revenue opportunity in autonomous driving than we previously thought there was.
So Tasha, as people go through the model, it's like if you're going to do that, download this on GitHub.
By the way, I strongly encourage everybody watching to download Ark's valuation model from GitHub. There's a link in the description. It's great to go through, change some assumptions, see what Ark's actual inputs are in their valuation model. It can be a great starting point for building your own valuation model. Not with their assumptions, with your own. And one final point that I'd like to make here, there's a big, clear and important distinction between Ark Invest's research, including their Tesla valuation model, their Tesla stock price targets, and their investing. I want to make sure that people understand this. Ark's research is completely independent of their stock trading and investing activities. Most people seem for some reason to conflate the two. Ark's research, in my opinion, is absolutely on point. They seem to get things better than just about anyone else on the planet. But in saying this, and remember, actions speak louder than words. I personally think that I'm a much better investor of capital than Ark Invest for my own goals. I'm going to smoke every single one of Ark's funds, absolutely smoke them over the next decade. I could literally go to sleep, wake up in 10 years, and I know that's going to play out. I don't have self-imposed constraints like a 10% limit maximum buying for a single stock in a single ETF. I'm not actively trading to generate additional alpha. I won't buy a steaming pile of feces that I think might make a short-term profit and trade in and out of this. I'm very simple in my investing. I do things quite differently to Ark Invest. I still think their research is pointing them in the right direction, and I still think that Ark Invest funds will smoke just about every other fund over a long period of time. But I want to really make sure that people get this. Ark's research is free. You can look at it, you can agree, you can disagree, you can criticize, that's totally fine. But I really want to make sure everyone understands. Big fan of Ark's research. Moderate fan of Ark's trading strategy, but as I said, actions speak louder than words, and I'm currently deploying literally 100% of my capital myself and extremely confident that I will absolutely destroy returns of, actually, you know what, fuck it, probably every single person on the planet, unless of course they have an identical stock portfolio to my own. And obviously, statistically speaking, there'll be a few people that absolutely crush me, but for being honest here, pit my portfolio against 10,000, in fact, fuck that, 100,000 other, you know what, fuck that, 1 million other portfolios, my 10-year returns, unless they have an identical portfolio, will smoke a lot of them. I did just say that. I know how arrogant that sounds to you and how honest and accurate that sounds to me. In short, Ark Invest expecting Tesla stock to be $4,600 per share by 2026 in their base case, I guess you'd call it, up to $5,800 in their 75th percentile case, meaning there's still plenty of potential upside even beyond that, just slightly lower probability. And just finally, I do want to reiterate, I've yet to find a better way to value Tesla than inputting a range of scenarios with varying probabilities and trying to get some kind of weighted average. But if anyone's got a better idea, please, I'm all ears. And lastly, don't forget you can join Patreon with the card in the corner or the link in the pinned comment. You'll gain access to my Tesla stock price targets, and if you'd like access to my Tesla valuation model, you can get that at the investor supporter level and above. The valuation model contains every assumption, the first robotaxis, cents per mile out every year throughout the decade, profitability, you name it, it's in there. And yes, it does include the 4 probabilistically weighted scenarios, the bear case, the base case, the bull case, and the hyperbull case, plus a weighted average stock price target based on every one of those scenarios. And hopefully at this point, it goes without saying, but just in case you're not sure there, my Tesla stock price targets aren't actually a prediction of where Tesla stock will be. They're just my best probabilistic guess at where Tesla stock would be based on the inputs in my model. Anyway, see you guys and girls over on Patreon. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.